Per usual, living on this channel for educational purposes only is not intended as financial advice. Let's take a look at some macro charts today from Macro Monday. Starting off with the usual CoinShares institutional crypto flows from James Butterfill. As he says here, we're getting extremely close to eventually maybe having a date for the Blackrock ETF. How this may work is you'll get the market excited on the news of the inevitability, and by the time it actually launches, we may put in an interim top, sell off significantly, and then go on our merry way from there. Just a potential roadmap. More inflows last week, which we will take, 66 million. Most of that, I believe, coming from the United States. Actually, no, Switzerland. Right, so that's 21 shares. Canada, Germany, outflows in the US, inflows in short Bitcoin a little bit, but really the big story was inflows into Bitcoin, outflows on Ethereum, inflows into Solana. And, this just tells the story of what we've seen really over the past week. ETH BTC has gotten crushed. Solana has done rather well. And you're definitely seeing excitement leading to the Blackrock ETF. So it'll be interesting what inflows look like for this week, because I'm expecting inflows to be bullish based on price. We did have a non-announcement, pre-announcement of the announcement of the Blackrock ETF. This is legitimate. Yeah, I know, maybe never heard of this person. I certainly haven't. But in any event, DTCC, the clearinghouse, gave iShares Bitcoin a CUSIP number, identification number. So it is getting closer and more real day by day here, and I think the market very much aware of that. On the legacy side of crypto stuff, GBTC still looks bullish, still above the cloud, trend still looks good, still in the channel. That inverted head and shoulders has pretty much played out as far as where you'd get the expected measured move based on the depth of the consolidation. The discount continues to close, which is good for the spot side of things. Again, whether or not this actually converts, unless you're in this thing, you probably don't really care. The discount, really the big gripe of the product, right, has closed considerably. If they do convert and have to compete with BlackRock on fees, they're going to get crushed. If they open this thing up, they're going to get massive outflows, most likely. They have 600K BTC. So from a supply-demand perspective, we may see some interesting price action around that. If you've been locked up in GBTC for 5 years, whatever it is, or more, you may want to take profits there. I don't know. Just something to consider. Everyone's sort of focused on Mt. Gox coins getting unlocked. And I don't see too many people talking about GBTC coins getting unlocked. And they wouldn't be unlocking because of the discount and the ARB there. They're just unlocking because they're in massive profits at this point, most likely. With all the news regarding Grayscale Genesis, Gemini Earn, DCG lately, it may be less likely that this ETF comes to light for GBTC sooner rather than later. It probably gets put off a little bit. That's what the chatter has been. Anyway, so there's that to discuss and think about. Very much a tradable product, probably the most institutional facing with arguably decent liquidity. If you look at something like BitX, which is a 2x ETF, you don't really have the volume to be able to move size there. So it's give and take for the institutional side, unless they just want to buy spot. ETHE still has about a 22% discount there. Chart still looks good, but from a relative value perspective, the question is timing, obviously. ETH has been kind of a limp noodle, if you will, over the past week relative to these other coins. An eventual move on ETHE, probably 17 to 20. But really you need to think about the ETH BTC or GBTC ETHE pair, right? And maybe a more appropriate rotation is once Bitcoin gets more overbought relative to ETH, right? Once that ratio gets blown out a little bit more, this kind of looks like dominance as well, right? This would be probably Bitcoin dominance somewhere around 55 to 60%. Anyway, just something to consider on that trade for the GBTC and ETHE enjoyers. And then I get a lot of questions about various Bitcoin miners like CleanSpark. This is a mining ETF, WGMI, basket of miners. And it's had a pretty aggressive downtrend. It's had a lot of red days here. It looks as though it's trying to exit from that downtrend on the daily. Maybe a mean reversion is in play. It's sold off pretty hard since those massive highs a couple months ago. And on lower time frames, arguably it has a triple bottom here in the making, inverted head and shoulders, whatever. So the miners in aggregate should look similar to this. They should look relatively ready for some attempt at a mean reversion at the very least. Before we get any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. And maybe something not a lot of people know about, but there are Lightning deposits on Kraken Lightning Network. I did 3 of them yesterday. Super quick. As far as volumes are concerned, again, I just like to look at what volumes look like here. Bitcoin at the top by a wide margin, double ETH's volume today, and probably the most coins I've seen with over 1 million in volume on the day in quite some time. So the markets are definitely waking up here. We've got some outperformance on the relative BTC pairs a little bit. DOT finally waking up a little bit. ETHE, like we talked about for a couple days now. Doge joining the party slightly there. And a few smaller, lesser alts, but it's still broadly not an alt move here. This is very much a choose your battles situation. Link still screaming. At this point, if I was just sitting down looking at this, it's not a chart I would buy, right? The time to buy this was weeks ago and everybody was looking at it. So I would definitely be careful here if you're looking to join the party. But eventually, 12 to 14, still very much on the table for Link. Back to Legacy here. If we look at the calendar, this week for me, not too much going on. PCE at the end of the week. Really, it's all about next week. Next week is Powell. It's job openings. It's ADP numbers, ISM, non-farm payroll. Next week's going to be a lot of data, a lot of podcasts analyzing what Powell said and how he said it, that sort of thing. We've got all these other numbers to digest. So next week's the big week for sure, in my eyes, on the Legacy calendar. Inflation has held below 3% for quite some time on Trueflation here, really since midsummer, I guess, May. And we're slowly creeping below 2.5, haven't quite had a sub 2% handle. So the rate of change, according to Trueflation, has slowed down. If we look at the Fed's own estimate, that is a decline month over month at 3.36. Previous reported number was 3.7. So that's what we want to see as human beings living in this world and in this country. Unfortunately, the aggregated inflation is still sky high, and this is what we're feeling on food costs, energy costs, commodities, clothing, etc. Right? We can celebrate this month over month number all we want, but ultimately this is what we're living through. And this chart has popped up again. I don't know if doomers are dooming because they want inflation higher, or it's good to look at. It's good to reflect on where this could go. The fight's not over, etc. This is comparing the 70s and 80s, effectively the double dip inflation, to today, with the argument being that, look, we're down quite a bit, but it's definitely not over till it's over, right? So something to consider. And on the dollar strength side of things, the US versus elsewhere side of things, we can look at data from the UK as well that Trueflation puts together. Inflation down from 22% at its high to around 6.25%. Government reported 6.7%, and their aggregated inflation almost 33%. So you're definitely feeling it on the other side of the pond here in the UK. And if we look at some numbers in Germany from Steno Research here, Germany's CPI, HICP versus PPI suggests that their CPI is going to continue to come down dramatically. So globally, we're headed in the right direction on a month-over-month rate of change perspective. But of course, you can slice this and dice this into core, super core, whatever, right? And get whatever value maybe you're looking for. Ultimately, though, I think everybody knows that inflation's still quite high on a multi-year basis. Flipping gears to bonds and treasuries a little bit. When I look at, we're issuing all this debt in the United States, Who's going to buy it? Where's that money going to come from? There's a massive pile of money still sitting in the reverse repo, which you can just think of as money that's outside of the ecosystem, short-term lending to the Fed. And there's still over $1 trillion there, which is good because the government in the United States is going to be issuing a lot more debt. A lot more debt's going to be rolling off into higher yielding debt. So it's going to be a problem longer term. People may be celebrating yields coming down, TLT may be bottoming in the interim. But I think the real question is, once the reverse repo runs out, who's going to buy this? As many people have said, China's not, Japan's not, Saudi Arabia's not, the Fed's not, right? Banks are not. It's just you and me out here buying TLT and money market funds, I guess. But this is a more important reserve to me than SPR based on how we are issuing debt. And the dollar's pulled back today, yields have pulled back today. This is good for crypto. This is good for risk. The S&P and NASDAQ certainly could use a day of retrenchment on the dollar, and that's what we're seeing. This was kind of a TKC clamp on technicals here, but I think lower timeframes, it's also still qualifies as a tiny little head and shoulders. In any event, I wouldn't celebrate too much until this is ultimately through the cloud. If we are by the end of the year through the cloud to around 103.5, whatever that is, we will likely see bullish crypto prices much easier in the face of dollar weakness than dollar strength. Now, if by halving we are sub 103 and we are on our way back down to 100 or less, then we're probably set up for a significant tailwind. We just have to dodge this whole recession thing and the world sort of crumbling apart into World War III. But there is a path to peacefully go to 103 here and have crypto have a nice tailwind for Bitcoin to hit that 42K level on the weekly cloud. Here's the 10-year and almost got to its 1618, right? I'm just measuring the high and the low here. This is classically where you'd expect anything to go, which would be rates to around 5% to 5.5%. Still think it gets there. There was a bit of a bear div on this anyway, and you did have Bill Ackman come out and say they covered their short today, and that certainly helped yields come down pretty significantly. TLT bouncing on that bull div like I talked about yesterday. So in the near term, this is good news for the long bond, good news for yields at the higher end. And the question is, we still have a ton of money sloshing around in something like a money market fund. This is from the Bitcoin layer. We've talked about this before, but we're still seeing tons of money inside of these yielding vehicles because why not, right? We're at a multi-decade high in yields for money market accounts. So it definitely makes sense. And there's a lot of dry powder sitting on the sidelines that really isn't properly allocated, arguably, to risk, or is waiting for, some doomsday event. On the other side of that, we have these conflicting data points. I see everybody stealing the BOA charts, including myself. And money market flows appear to be slowing. And my question is, where are these going? Are these going into longer term treasuries, or are they going into risk? They're probably going to longer term treasuries if I had to guess, but I don't really know. And then if we look at treasury inflows, we're seeing strong inflows there. So this maybe just be a transition from short term to longer term positioning. Not exactly sure, but this is really the chart that suggests, look, we are perhaps overly allocated to cash historically, right? And everyone's excited and celebrating, including myself, right? I've personally allocated to cash in a bigger way than I've ever been, simply because, hey, there's some yields that are pretty lucrative. So this chart is just saying, look, the average is around 13% as a percentage of AUM, and we're exceeding 15 here. So maybe we are slightly overly allocated to cash, just something to consider. And then back to the long bond. If you look at the history of the 10-year, all the way back to, I guess, inception, 1928, we've never had a string of 3 negative years, and we've never had the drawdown this large, right? And if you think about the 60-40 portfolio, 60% risk, 40% risk off, equities, bonds, whatever. This is definitely problematic for that portfolio, which has done quite well historically. So the question is this time different, or is it over for the 60-40, right? I think people were talking about that last year, continue to talk about that this year. And this is another great chart from Charlie Bilello. If you're wondering why are people bothering, putting money into these yields if yields go higher, bond prices go lower, right? It seems like, to me, maybe it's a bit too early, but also people are allocating in a big way to this stuff. And if you look at the forward bond returns, 7-year forward, you get a higher return based on where the yield is sitting. So the argument here is like, look, yields may go higher, but it's also a very good indicator historically for the forward return, which is definitely a decent argument to start allocating into this stuff. The yield curve is uninverting pretty rapidly, continues to uninvert, but it's important to remember, the recessions don't come until much after the uninversions typically, right? Look how late relative to where these uninversions are happening, where the recession finally shows up. Unemployment's still extremely low. We're still adding jobs based on what they tell us. So it certainly doesn't look like recession anytime super soon. People are talking about 2024 for sure. That's when the recession is coming. I don't know. We'll see. On the S&P side of things, again, it's a lot of short-term chop, a lot of lack of clarity for me on direction. We've mean reverted. We've hit that 4,200 level. Not quite oversold territory, not quite in full-blown bearish territory. The cloud says it's bearish. I really don't like the S&P until we're back above 4,400, I guess, 4,360. You can sort of move down, at least for me, where I'm rotating in and out of stuff based on where the cloud is telling you those levels are important. So not a lot of direction overall from the S&P and the Qs. Again, it's all about this diagonal trend line that everyone's watching, guaranteed at this point. Still in the cloud, not quite to the 200. Just a lot of chop. What to watch for here is a flip and potentially reflip bullish. Currently, cloud is bullish, flipping bearish. If the cloud were to reflip bullish with price above cloud, bullish decay cross, right? Those are all classically long entry signals, and that would align with this diagonal, assuming price doesn't completely fall out of the bottom. And this, the hero trade, I'll talk about it every week till we will it into reality. An idea to watch, right? No guarantee. It invalidates at around 330 and starts to get more real around 380. So something to just think about longer term. Now, if we look at something like the low caps IWM, this chart looks tragically awful, right? This is like the opposite of Link, where it's chopped around in a range for over a year and looks like it's ready to break down. Certainly doesn't look like a chart to me that wants to turn a corner just yet. It's at a pretty massive resistance, turn support, potentially turning resistance here again. So it doesn't look too bullish for low caps as we stand here, and then just picking out a random chart, right? If we think about AVAX, DOT, and a bunch of other charts that have sort of broken down on their reversal potentials, this is PayPal, and PayPal has broken down below its falling wedge, arguably, and may start to see some, parabolic puke into that 43 level. So on the legacy side, I do think some of this stuff's getting looking bad enough to start thinking about, right? As a longer term play, maybe over the next year, and relative to technicals, it's down, significantly. Not saying PayPal's a good business, but I'm just looking at the technicals here. And then flipping gears to some random data points that I thought were interesting this week. Commercial real estate stuff is still just a slow brewing dumpster fire in the United States and China and everywhere, right? More so in the United States because we haven't quite gotten back to the office. There isn't a need for commercial real estate, but as rates stay high and as renters effectively have to renew their contracts, they're choosing less and less to want to renew. There's less of a demand, right? And you're seeing that just drop off a cliff as far as the sales volume for CRE. And this just hit today that a condo developer was put into receivership in Canada. Not quite CRE, but maybe mixed use, mostly housing, higher end. It just feels like we're starting to top out in a lot of credit and debt markets. This has been making the rounds this week with car payment delinquencies in the United States reaching multi-decade highs. This is subprime 60-plus day delinquency. So it's certainly getting harder to have debt because the debt is getting extremely expensive. This is credit cards in the United States hitting an all-time high on average, right? That's the average, which is extremely scary to think about, at 29%. And then flipping gears to China, lastly here. I don't know if it was, there's been a deluge of kind of Chinese data. It's hard to trust anything for me out of China, but Looks like we have seen a liquidity injection. China's been kind of in trouble in the economy department lately, to say the least. And maybe this has helped global liquidity. Maybe this has helped bring up crypto prices, right? Part of the question is like, who's buying Link here? Who's buying Solana here? And why? I don't really care, but it's always interesting to think about. And maybe part of it is coming from China. I don't know. And if we look at Chinese banks sending funds overseas, that's reached multi-year highs as far as outflows from banks in China. And it just makes that Chinese trade prediction look even worse. This is high yield real estate in China, down, I think, 82%. In China, from what I know, a lot of the savings goes into sort of ghost real estate or empty real estate. And it looks as though that bubble is bursting pretty hard over there. And we've seen Evergrande, we've seen Garden Party, I forget the name of it, right? All these names that you wouldn't otherwise recognize, but are getting headlines based on not being able to meet their debt payments in China. And then lastly here, yields are at an extreme discount. And collectively, China's in some trouble here, right? They've got issues to deal with. They've got youth unemployment at record highs, so high that they stopped reporting the data, right? So that's all I have for this week. Hopefully the focus from the legacy crowd rolls into spot Bitcoin ETF, right? That's potential what we're seeing here as far as where's the next trade, where's the next move and momentum. And with the US dollar weakness and Chinese weakness, we may see a nice tailwind here towards the end of the year, as typically we do in Q4. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.